Welcome back to Crypto Corner. I'm Adam Lynch, Director of Equity Modeling at the Schwab Center for Financial Research, here to take you through the week in crypto. Let's start with the latest on crypto legislation. So last week we updated the audience on progress that had been made by the Senate Banking Committee after Chairman Tim Scott released their amended crypto market structure bill. The Senate drew a sharp line in the sand on stablecoin rewards, which in the end was one of the major issues which caused Coinbase to withdraw support, likely delaying the situation for a while. However, this week the Senate Agricultural Committee and its chairman, John Boozman, released their draft saying it's time we move this bill in a statement on Wednesday. Unfortunately for fans of bipartisanship, after months of negotiations between the two parties, the text of this draft does not have the backing of Ag Committee Democrats, and it is essentially a GOP-only crypto draft. That being said, some Democratic priorities did make it into the GOP draft. For example, the text includes non-binding language aimed at pressing the Trump administration to appoint Democrats to the CFTC, a key priority for the party. Now, as a quick reminder, the two versions of this bill are necessary because the Ag Committee has jurisdiction over the portion dealing with the CFTC, which would gain new authority to regulate crypto assets under the proposal. The Banking Committee, on the other hand, has oversight over the second half of the legislation, mostly issues regarding the SEC. Now, there was clearly hope that bipartisan agreements could have been reached by both committees, therefore making a combined bill easier, because there is a need both politically and practically for Democrats to support the final legislation, which seems to have hit its first hurdle this week. Meanwhile, Bitcoin has remained around $90,000 or so, while silver and gold have continued to surge. So why hasn't Bitcoin acted as a store of value? Well, the short answer is because instead it's acted like a high beta risk asset. But the longer answer is a bit more complex. So first of all, macro dominates everything. Bitcoin has struggled to decouple from global liquidity. Gold does fine in fear and easing environments, while Bitcoin still seems to need some easy money in order to perform well. Another thing is that institutional adoption via ETFs has brought more momentum trading and forced selling, which just makes Bitcoin more correlated to the market, not less. Another thing is that there's really no crisis to hedge. The Bitcoin store of value narrative works best during phases of currency debasement fears, banking stress, sovereign risk events, things like that. And that's not really what's happened over the past year or so, even though the US dollar has been on decline. We're in a slow grind, sticky inflation mode right now. It's not really panic. Investors are still trying to maximize returns, not account for that tail risk. And then another thing is volatility. A store of value typically needs to be relatively stable over the short term, but Bitcoin still has some wild swings, which probably scares off capital, which otherwise would treat it like gold. And then the last thing here is that we are so early. Gold earned its reputation as a store of value over thousands of years. Bitcoin is trying to be digital gold, a tech asset, a macro hedge, a speculative trade, all sorts of things. And it's trying to be them all at once after only 15 years of existence. Overall, I think markets would prefer fewer mixed signals and for Bitcoin to deal with its identity crisis a bit before it's fully treated as digital gold. And finally, we saw another crypto IPO this week, with BitGo going public with an approximate valuation of around $2 billion. If you remember, back in 2025, several crypto-related companies had IPOs, including Circle, a stablecoin issuer, Bullish, a trading platform, and Gemini, a crypto exchange. Unfortunately, as of this morning, I think Circle is down about 14%, Bullish 46%, and Gemini down around 69%. This performance does coincide with a drop in Bitcoin's price from over 120,000 down to this 90K range. This week, though, investors were offered their first opportunity to get direct exposure to crypto infrastructure with BitGo, a crypto custodian. Its IPO shares were priced at $18 per, and the company ended its first day trading on the NYSE up nearly 2.7%. They are one of the first related crypto IPOs to focus on infrastructure and compliance rather than price speculation, which makes them stand out compared to those others I mentioned earlier. BitGo provides custody and security service for digital assets, primarily catering to the institutional world. The firm has become a key part in the crypto market's back end, and they serve as custodians for several crypto exchange traded products and act as a key bridge between traditional finance and digital assets. This launch could help provide insight into how Wall Street values crypto firms that actually have revenue and institutional clients. And then another last interesting piece of this story is that unlike most IPOs, BitGo is taking more of a crypto native approach by putting its shares on chain from day one via a partnership with Ondo Finance. Now, this aligns with growing trends of moving traditional financial assets onto the blockchain to help speed up and improve transaction efficiency. It's becoming pretty clear that tokenization like this is shaping up to be a key topic in 2026. And that will do it for this week's Crypto Corner on Schwab Network.